Okay, hi everyone. Thanks for attending this webinar on development finance. My name is Tony Barbone and I'm the Managing Director of Private Mortgages Australia. And yeah, we're going to talk about all things development finance. So let's jump. We've got a fair bit to cover, so we're just going to jump straight into it. So let's take a quick look at the different type of private loan products that Private Mortgages Australia has to offer. We have two specific types of loans that we provide, and the first is first mortgages, and we have interest rates from 9% per annum, and our loans are between 3 to 24 months, and we cater from anything from 100,000 up to 10 million. And second mortgages we have from 15% per annum. These are typically shorter in loan terms. We have 3 to 12 months, and the size is between 100,000 to 2 million. Now, it's probably worth mentioning that all of our loan terms do come with a component of prepaid or capitalized interest, which means that we don't need to look at serviceability. And that's because the loan is actually prepaid for the term. So an average type of loan for us would be, say, for instance, 6 months prepaid. So the interest is capitalized for 6 months, and then we might have, say, 3 monthly extensions in addition to that. So all of our loans do come with extensions, and it really depends on the length of the original prepaid term. It would depend on how many prepaid extension periods we provide. And the other thing worth mentioning as well is that we have a difference between as-is valuations and as-if complete valuations. So our base rate of 9% per annum, now that is in relation to lending on as-is valuations, whereas as-if complete valuations, our base rate, well, we're going to be looking at sort of early teens would be the base rate for anything that has some form of development risk. So I just want to differentiate the difference between as-is values and as-if complete values, where we're lending against the as-if complete value of a development project. Okay. So let's have a look at our different loan-to-value ratios, and the way that we break it down is we really base it on the Genworth financials. The Genworth financial categories that have been provided. So what's happened is Genworth have gone around and they've analysed each of the different suburbs within Australia, and they've categorised them in accordance with population size. And they break them down into 4 different categories. So category 1, now that's major metropolitan areas, so be it your Sydney, Melbourne, Brisbane's, and the greater suburban areas surrounding them. Category 2 are your smaller type of your larger regional centres. Now these would be, for example, Orange in New South Wales, or perhaps like a Shepparton in Victoria. The next, so category 3 being the next one. Now that's more in relation to a smaller regional town. And of course, category 4 is sort of all other postcodes. This is sort of in the middle of nowhere. If they don't fall into category 1, 2, or 3, they're lumped into category 4, and they're typically usually have a rural or primary production type of flavour to them. So we get a lot of rural land in these types of locations. So that's the 4 different types of categories that we have. The other thing worth mentioning is our maximum loan-to-value ratio. So we can only ever go up to 80% LVR on residential property. Now, it's probably so, and that's really in rare circumstances. Most of the time, we sort of lend 75 or below, but we are private lenders, and private lending is all about problem solving. In some circumstances we can lend up to 80%, but we just need to make sure that the transaction makes sense. So just as an example, it could be that a property is going to auction, or perhaps it's sold at auction, and they've sold it with a 60-day, say like a 90-day settlement. And so what they need, the borrower just needs a short-term bridge for a 3-month period, just to settle so they can access the funding quickly for some other genuine business purpose. Yes, and as you can see, the different type of security, we have different maximum LVRs. We always prefer to aim to hit the targets within the categories, but again, there are, if the transaction can be commercially justified and it makes sense to us, then we're happy to lend to the maximum. Great. Now let's have a look at development finance and the capital stack. So this is how we look at a development project. And if you look down at the bottom there, you'll see that the senior debt is the most secure position, it has the lowest amount of risk, but again, it has the lowest amount of return. Okay, the next level up from that is the mezzanine debt, or sometimes otherwise referred to as junior debt, and this sits behind the senior debt. Okay, so this takes on a higher degree of risk again. And then the next two levels up from there, that's preferred equity and common equity. This is not a space that we're playing in at present, but we do have our eyes set on moving into the pref equity space in due course. This is more the money required to be put in by the developer. Okay, so you just want to differentiate the difference between equity, which sits at the top, which is much higher risk, but then much higher return on investment. And then as you come further down the capital stack, the senior debt's in the most risk-averse position, but they make a return less than everyone else in the project. So just worth bearing in mind before we move into the different the different products that we have available. So let's have a look at the products that PMA has available. So senior finance, so this is first mortgages. So secured by first mortgage on the project, anywhere up to 24 months, and we have a gross realization. We lend up to 70% of the gross realization value exclusive of GST. Now, most of our typical terms are around 12 months plus extensions, as we covered earlier, and that's really the space that we operate in for the senior construction funding. Rates would usually be sort of they're usually double digits, so you're probably looking, I would say, at least 12% for development risk type transactions. So yeah, early teens. The next product that we have, mezzanine finance. Now this is the secured by a second mortgage over the project, and this is again terms up to 24 months. And it's up to 70% of we have a firm limit of 70% of the gross realization value exclusive of GST. In terms of rates, you're probably looking about late teens to early twos early 20s would be in terms of the interest rates, and it really depends on it has quite a lot of factors to bear in mind. It depends a lot on the final LVR, what the project is, what the developer's background is. There's a lot of variables to consider when it comes to pricing. So we just typically tend to work on a bit of a rough ballpark figure until we can get a closer look at the transaction and provide a more detailed quote. Completion finance. Now this is a different beast altogether. Completion finance, this is again, it's secured by second mortgage, and it's usually up to 6 months. This is really just for a very short period of time when a project is near completion. But something's gone wrong, and they have to access funding quickly in order to be able to complete the project. Again, the lending up to a maximum of 70% of the gross realization value exclusive of GST. Now, let's have a look at the timelines. So, the way it works on the capital, if you recall the capital stack that we covered earlier, the way it works is that the common equity, pref equity, and mezz, all of them get drawn down first. So all of their different those different funding sources are used up first before the senior finance provider puts any money into the project at all. And then at the end of the project, the senior finance provider is always the first person to get repaid. And that's why they're taking on the most risk-averse position out of the capital stack. The next level up is from above senior is the mezzanine finance provider, and they get drawn down before the senior finance provider, okay? But they get paid back after the senior finance provider has been paid out. The other thing worth mentioning is that the senior finance provider holds the cost to complete. Okay, so this is a really important concept. What that means is that the senior finance provider will hold on the final, usually 5% of the project, and that's really designed in order to compel the builder to complete the work on the project, and to ensure that the certificate of occupancy is issued, and the builder won't receive that last 5% until that's done properly, until it's all been signed off. And then once the certificate of occupancy has been issued, then the senior finance provider will release the cost to complete. Okay, when the pre-sales kick in, or the senior finance provider is paid out first in priority to everyone else in the capital stack. Now, completion finance. So, as I mentioned earlier, this kicks in towards the end of the project. Okay, so usually something's gone wrong. Maybe they've hit rock, and maybe they've used up their contingency allowance much earlier on in the project, and the senior finance provider won't allow any further drawdowns for contingency under the senior facility. So this poses a bit of a problem for the sponsor, because developer, sponsor, I use those terms interchangeably. The sponsor might not have it. They've already contributed all the money that they have available for into the project already. So there's a bit of a problem there. So this is where PMA can come in and provide a very short-term facility just to see the completion of the project. Now, it's probably worth bearing in mind that PMA, we can't actually provide completion finance if there's already a mezzanine finance provider in second place. So that's just a key thing I just want to sort of point out here, is that PMA can only come in and provide completion finance if there is no existing mezzanine finance provider. Now, I mean, there are exceptions to the rule. It could be perhaps that the developer has their existing portfolio of assets, and we can take some additional security over something else. Each transaction is different, and we need to look at it on a case-by-case basis. So that gives you an idea of the different types of timing around the products that we have. So let's have a look at some case studies now. So here's an example of a senior finance facility that we put together. So it's a development site in Willowvale, Queensland. The sponsor owned the property for several decades, and they decided that they wanted to carve up the block. They didn't need all that land, and then they decided to carve up the block into to retain the existing dwelling, and then create an additional 4 lots. So the 4 lots were 100% pre-sold, but unfortunately the developer couldn't access traditional bank finance because they couldn't demonstrate serviceability to meet bank standards. Now, we see a lot of this. The banks are withdrawing from the development market, and there are plenty of good projects out there that just can't get funding through traditional bank channels. So let's see what we did. So the valuation, we got it independently valued at 2.125 million, and we provided a senior facility secured by a first mortgage over the entire project for 1.475. That's an LVR of 70%. Our interest rate, 18% per annum, and a term of 5 months. So just in relation to that interest rate, that was a little bit high for a number of reasons. One, it was the sponsor's first development, so they didn't have any pre-existing history or any existing development experience. Secondly, it's for a 5-month term. And thirdly, the LVR was at our maximum. So if we can get a lower LVR, be it 60, 65% LVR on the end value, our interest rates can come down accordingly. We also did do this transaction. It was probably about nearly 2 years ago now, and we've found that we have since had to scale back our pricing. So for a similar transaction these days, we would probably, that would be sharpened up a little bit more than that. The case study Mezzanine Finance. So let's have a look at another one that we did. The development site in Glen Waverley, 3 townhouse development. The borrower wanted to build all three and then retain them for the long term, and they couldn't meet the bank standards of serviceability because they didn't have any pre-sales. So they would be, it seemed bizarre for the bank that any developer wanted to actually build and keep. They look at it from the perspective that you should build and then sell. So they just couldn't get traditional bank finance for that reason. So let's have a look at the numbers. So it's as if complete. We've got an as if complete valuation done on the project for 4.58. The first mortgage. So this was interesting. The first mortgage that they got from HSBC for 1.61. This was the facility that they got from the bank in order to settle the purchase contract. So they settled it with this facility, and it was a very low rate of I think it was around sort of 4% per annum. And so what we did is we approved it as a mezzanine finance facility for 1.358, but we sat behind that. So we sat behind the HSBC facility. Where this one was a little bit different is that we provided the construction, the entire building contract. So we funded all three of the townhouses from start to finish, and we were the ones that were holding the cost to complete. Okay, so we managed all of the drawdowns with our quantity surveyor, and really brought the project through to completion. Okay, so LVR of 64% per annum. 64% LVR. And an interest rate of 23%. Now, if you think about it, if you combine the existing first of 1.61 at say 4%, and then you add our facility onto the back of that, it really the weighted interest rate on that for the term of the loan wasn't too bad. So the developers just simply weighed up the cost, and it made sense to them, so they decided to move forward. Now we've had a really good outcome on this one, and this developer. They do have multiple upcoming projects, so we think that we'll be asked again to provide some pricing on some of their upcoming projects. Here's another one. This is completion finance in Altona in Victoria. So this was another 3 townhouse development. They had 2 pre-sold. They had been self-funding the project, and they were very close to completion. They were 90% complete. The issue was that they had an existing loan that they had used to acquire the site to settle the actual property, but they couldn't secure bank finance for the project because it was their first project. They couldn't demonstrate serviceability, and it was incomplete security. It was too late for them. They decided to start immediately, and it was the banks don't like anything incomplete. So, so let's have a look at the numbers. So valuation of 1.95, first mortgage from Latrobe at 520. We provided completion finance on a second mortgage basis of 435,000. So LVR was 49%, interest rate of 22%, and a very short term of 2 months, plus extensions. So they did actually take up, I think, 2 of the extensions. So the overall term on this one was 4 months. So let's have a look at the fees and charges. So for all of our loans have an approval fee, and the way it works is that the approval fee is payable at the first advance. So when the facility is first drawn down, that's when the approval fee is paid. We don't charge it. It's not an out-of-pocket expense for borrowers. Okay. In terms of the out-of-pocket expense, we do have an assessment fee. The assessment fee is between $550 and $770 based on complexity. And, if you've just got a single company borrower, a single property, and a single director, that's going to be on $550. But if you've got multiple properties, multiple companies, multiple individuals, that's going to be much more complex. So we've got to do a lot more searches in those situations. But we cap our approval fee at $770. If we have to get a valuation and a quantity surveyor report, these fees are on a flow-through basis. So we will arrange quotes, and then we ask the borrowers to pay for the valuation QS fees as required. So that's that's on a flow-through basis. The other thing that we have is all of our loans need to be documented by our solicitors, and so the legal fees are usually around sort of $3,000 to $4,000 based on complexity. And the other thing is, upon acceptance of our formal letter of offer, we ask for a part payment of the legal fees, which is just $1,100 as a part payment towards the solicitor preparing the documents. In relation to the approval fee, the higher the loan volume, the lesser of the approval fee. So there's less of an approval fee. Okay, here's our inquiry and settlement process. So just fill out a quick app, and this is just a simple little 2-pager. And the last half of the second page is just a space for notes. So we've really got it down to just the very basic points that we need in order to populate an offer. So what we do is we receive the information, we do an initial assessment, then we issue our indicative letter of offer. That gets issued, and it has an indicative interest rate and our assessment fee. Once the indicative letter of offer is accepted, we then do the bulk of our due diligence. We do all of our due diligence before we formalize our final letter of offer. Then once that's issued and signed off, then we just simply book in time with the solicitors and settle the matter. So it's very streamlined. It's taken a lot of trial and error over the years to get it as streamlined as it is. So yeah, it's a very efficient process. Okay, so when we look at a transaction, this is how we look at a transaction. So it's probably worth showing you how we weigh up whether or not a transaction is going to be viable or not. So first and foremost, is the transaction non-coded? Is the loan for a non-coded purpose? So Private Mortgages Australia doesn't carry a credit license, and a credit license is needed for credit providers that provide finance that's for domestic purposes. So if someone wants to buy a home that they're going to live in, that's coded by the National Consumer Credit Protection Act. If someone wants to go, buy a jet ski or get a credit card, those types of products, they're all governed by NCCP. But if it's for a genuine business purpose or a corporate borrower, that's considered non-coded, and that's the space that PMA plays in. So if someone's coming to us to borrow money to go on a holiday, it's not for us. We're just not going to be able to help out. So that's the first thing we look at, non-coded. The next thing is someone prepared to pay more than 9% per annum? Now, remember, it's 9% per annum for as is. It's our base rate of 9% per annum is on as is security. Think of residual stock. There might be a developer that has some leftover stock that they haven't sold yet, and they might have that is an example of a 9% per annum loan. So that's our base rate. Again, bear in mind that for development purposes, our base rate's going to be in the early teens. Okay, so unless a borrower's prepared, if they're not prepared to pay these types of rates, then we say go to the bank because the bank's always going to be cheaper than us. The next thing that we look at is the postcode and LVR analysis. Is someone looking for a 90% LVR on a development site in a Category 4 location? Well, if they are, it's not going to make any sense for us. So we'll just pass on the transaction. However, if they're looking for a 65% LVR on a development for some senior construction finance in a Category 1 location, that's probably going to that makes sense for us. So that's something that we would be happy to move, to consider further. The other thing worth looking at is that exit strategy of the loan. So, we don't take into consideration serviceability because all of our loans have that component of prepaid or capitalized interest. So we need to know how a borrower is going to repay a loan at the end of a very short term, be it 6 months, 12 months. A lot of the time there's pre-sales or a combination of pre-sales plus refinance of the residual stock. Then the other things and the other thing to consider is why can't someone get bank finance? So, if they can get bank finance, don't come to us. That's one of the first things we ask. Can you get bank finance? Yes, great, go with the bank. But there's usually the banks are retreating from the development space, so there's plenty of good projects out there that just can't secure bank funding, but we just need to know why. And of course, when do you need to settle? Is it an urgent transaction? Do you have a development site under contract that you purchased, 12 months ago that you need to settle on? You can't get any extensions. We need to know that this thing is, we need to know the drop dead date. If we can't settle by next Wednesday, you got to let us, otherwise the whole thing's going to fall over in a heap. You got to let us know upfront. We need cooperative borrowers to be able to make those urgent settlements work, given the deadline. So, assuming all of those make sense, we can quote. Great, let's have a little bit of a closer look and at a scenario that we covered earlier, the completion finance scenario. And I'm going to say something that's probably going to rock your world, but interest rates are irrelevant. And you must be thinking, no, they're not. Well, we say that they are. And we look at it from the perspective of the total cost of the loan. Now, I've seen this all too many times where you have a really, really cheap headline rate, but then, they stack it with a management fee on top, and they've got out-of-pocket fees, and there's the whole waterfall of fees that exist that are just, but everyone just is hell-bent on the rate. Whereas we go, look, let's add up all of those costs, and then you work out how much it's going to cost. And then you just simply make a decision if it's going to work or if it's not going to work. So let's look at, in a little bit more detail, the completion finance transaction we looked at in Altona for the 3 townhouses. So we provided them a $435,000 second mortgage in record speed, I should say, because they needed urgent funding. We provided that on the development site, and they paid 22% per annum. We charged the approval fee and the legal fees. Total cost of $34,000 and some change. Now let's look at. Now this is a very high-level development feasibility, but let's have a look at the numbers. Okay, so the gross realization is 1.95. They purchased the land, including plans and permits, for $650. You've got the stamp duty cost. Building cost of the 3 townhouses, $650, and the other costs. Look, let's just lump in the agent, counsel, and holding costs. So other costs of about $115,000. So total cost of $1.45. Pretty healthy $500,000 profit in the deal. Now, let me ask you this: would you, in order to get the deal done, what would you do? Would you pay for a completion finance facility where you're going to lose, for 7% of your overall profit being $34,000, or would you go off and find a joint venture partner when joint venture partners are, typically between 25 to 50% of your profits? It's pretty straightforward when you weigh it up in terms of those costs. It's going to cost you a far lesser amount of money to bring in a arm's length completion finance provider versus finding a joint venture partner for the project where you're giving up more of your profit. Okay. So here's what we specialize in. It's urgent funding. You need a fast approval, and you can't wait 4 to 6 weeks that traditional banks take. Development finance, which we've looked at in great detail here. The different types of products we have available, senior or mezz or land bank. Asset lending, so we are hell-bent on knowing what the value of the security is and what the exit strategy is. We don't look at serviceability. We're the complete opposite to the bank. Okay, so banks look primarily firstly at serviceability and then the asset value. We just need to know what the asset's worth and what the exit strategy is. ATO debts, we see this all the time. Borrowers just can't get further extension or a payment plan from the ATO, and they need something quickly because the ATO is coming in to wind them up. So yeah, we see a lot of this, and the banks just don't lend to anyone who has outstanding ATO debts. Okay, now refinance existing loans that have expired or they're close to expiring. Now we've seen a lot of this, and we've done quite a fair bit of this. There are caveat lenders out there that are, they say that they can get stuff done in 24 hours. I'm I'm yet to see that happen, but their rates are, they're priced accordingly. Their rates are usually between 4 to 6%, usually per calendar month. But if the loan expires, then the interest rate steps up to sort of 10, 12, 15, 18% per calendar month. It really adds up. So we've done transactions where we've refinanced out an existing caveat loan, even just for a short period of time, but they've saved a dramatic amount of money. If you're considering, they might have refinanced to us at sort of circa 24% per annum, which is a hell of a lot less than, say, 144% per annum. So, yeah, worth worth bearing in mind. Valuation, not contract. So, we live in the real world. Sometimes you can snap up a bargain, and you just want to make sure that there's probably some sort of value add opportunity, or you want to lend against what the value of the property really is. We see a fair bit of that. Paying out business partners, pretty self-explanatory. Urgent business opportunity. Now, look, this could be, stock. We've seen we've seen a lot of scenarios where we've helped out people that have needed access to urgent business funding so they can take up a great opportunity. Perhaps the competitor's gone out of business and they can get all the equipment, something like that. And of course, credit impaired. So, there's 101 different reasons why people can't get bank funding. One of those is because they just have credit, some credit blemishes. We're pretty open-minded. As long as the transaction makes sense, then we're prepared to do it. Great. Let's look at the PMA way. So we're all about cleaner loans for better results. Now, how do we do this? It's we charge super low upfront fees, $550 to $770, so it's capped. It's really just to cover the cost of our searches. That's that's very different to other lenders out there that charge tens of thousands of dollars sometimes, and that's just for them to look at a loan, and it's the fees are non-refundable, and sometimes they say no. Terrible thing, which is unfortunately given private lending a bit of a bad name in recent times. So we want to do the complete opposite to that. So no charging clauses in our indicative letter of offer. No cancellation fees in our indicative letter of offer. We've seen it all too many times when borrowers have gone to another private lender out there and they've been provided with an indicative letter of offer, and the rate says from 1% per calendar month, or 12% per annum. And then they sign up for that, and then when they get the loan documents back from the solicitor, they go to sign them, and the interest rate's all of a sudden 4% per calendar month. That's a big difference. So, and then if the borrower withdraws at that point in time, then the lender has the ability to then enforce these charging clauses and the cancellation fees. Okay, so just something to be mindful of. We do the complete opposite. It's all very transparent. We make sure that there's no cancellation fees and no charging clauses in our indicative letter of offer. Valuations, we usually get two different quotes. So we've got to bear in mind that sometimes, we do have to take into consideration the speed in which we can get a valuation done. And we do have priority service agreements with some of our valuation firms, but the price is going to be a little bit more. So we're going to take that into consideration as well. So we usually get two quotes, and then we provide those quotes to the borrowers, and we just ask them to pay them. So it's all done on a flow-through basis. We don't add any margin there's no margin that we add to arranging valuations. Legal fees done on a flow-through basis as well. Very straightforward, usually between $3,000 and $4,000, depending on complexity. This is another thing that we do. So we rebate unused interest on extension payments. So mentioned earlier, all of our loans come with a component of prepaid or capitalized interest. And let's say it's a 12-month prepaid loan, and then we give them, say, 6 monthly extensions. They use up, let's say that they've got a settlement booked in 30 days, in say 2 weeks' time. So we just ask them to pay 30 days in advance, and then 2 weeks into that, they settle, and so we refund the unused interest. I think that's pretty fair. The other thing, we've spent countless hours building custom software, probably far too many hours if you ask me, but what it has allowed us to do is be able to provide those fast approvals a lot quicker. in most circumstances, if we have all the information, we can get a proposal or a quote back same day. The other thing that we have is a really high level of repeat clientele, and we see developers especially as the types of borrowers that we want to work with for the long term. We understand that they could have a very strong pipeline of business coming up, and they're going to need a variety of different products. Perhaps we might do the land bank on one project. We might be providing senior construction funding on another, and heck, we might even do some completion finance on another one. So, we can take on a lot in terms of the different product offerings that we have, and we want to do a great job. And we find that we are, because we're often asked to come back and quote again and again. And this all really boils down to our win-win approach to lending. We love to see win-win outcomes. We want to set up our borrowers for success. And if we do a great job for them, we're sure to see them come back again and again. So that's really it in terms of our different suite of our development products. So if you do have a scenario, please give Shanta Lobo a call. She's our senior relationship manager. She would be thrilled to hear from you, and she's just really good at working through scenarios. She does all of the quoting for us, and she just likes solving funding problems. So you are certainly in good hands. Check out our website, privatemortgagesaustralia.com.au. You can check out our social pages as well. We are going to cut it there just because I'm mindful of the time. I wanted to just keep it short and sweet. If you have any quick questions, give Shanta a call, and we look forward to chatting to you soon. Okay, thanks. Bye.